Now, Rabobank International's Asia Head of Financial Markets Research, Adrian Foster, joins us now live from Hong Kong. Adrian, hello. Thanks for joining us today.
Hi, morning.
So the fund is roughly $800 billion if you add the IMF contributions to what's already there. The big question is, Adrian, is it enough?
I think it is a sizable increase in the war chest, but if you think about some of the divides between the members of the G20, and as mentioned by the IMF MD, the G20 and the IMF came together for this raising. If you think about some of the divide sitting around that table, I think it's easy to think that the ayes would have largely had European accents, and the nays would have probably had non-European accents. So I think there is a divide down that approach. And if you think about the practical significance of that, next time Europe needs, or if indeed Europe does need further support, I can't help but think there'll be increased conditionality applied by the IMF to the release of any funds to Europe, because of course of the strength of the dissent or of the questions raised by the non-European members there. So I think that'll be a very important issue if indeed Europe does look to the IMF for some more funds, just to see whether that conditionality does in fact tighten or increase, and my best guess is that I think it will. It'll be a very uncomfortable situation for Europe to go accessing those funds, I would think.
And of course, Adrian, pressure from the IMF and from various nations for the ECB to do more, but the ECB holding firm, saying, you know what, we've done enough.
I think, to be fair to the ECB, they have done a lot. I think it took a long time for there to be enough trust around the table, so to speak, in Europe. But those are two LTROs, around about €1 trillion of liquidity into the system. You'd have to think that if indeed the European banks who have accessed that liquidity would not turn up to government bond auctions, there'd be a very real issue unfolding, and that would be very, very dangerous, I think. And it's hard to see the IMF with really changing that equation purely on their financial firepower alone. There would have to be a lot of suasion put on these European governments, I think, to keep with the tightening approaches that they're currently talking about, they're currently putting through, but there's still a long, long way to go on that path.
But Adrian, I mean, political risk isn't easing, because we know what's happening in the Netherlands. Dutch austerity talks, of course, failed over the weekend, so there could be an election there. It's not getting any easier on the political front. Look what happened in France over the weekend. We've got the runoff between Hollande and Sarkozy. These sort of factors aren't going to make for easier times in capital markets, are they?
I think that's very true. If you look at the Netherlands, I tend to put the Netherlands political machinations on the safe side of the ledger, if you like. I don't think that's an issue which really which plays out negatively for the Netherlands. It's an issue, of course, for the domestic political body, but not something, I think, which really spills out over the broader Eurozone. The French situation, of course, is very interesting. The French, of course, major pushes with the European measures put in place so far, and a change of leadership, if indeed it did occur, would at least put question marks over their continued support. It's going to be a very interesting day on the 6th of May, of course, which is when the second round of the French presidential elections held.
What does it mean for the various asset classes, Adrian? I mean, it's certainly less of an appetite for risks today. We've got money moving into the end. Coincidentally, ahead of the BOJ meeting later this week, what can we expect from the BOJ? More monetary easing?
Well, of course, the last thing the BOJ wants is more and more people parking funds in the yen, of course, because the strength of the yen, I think, is the biggest negative factor overhanging Japan's economy as it's sort of finding its feet with the post-quake recovery. I think the BOJ do stay in easing mode. I think they had a limited success, was that a couple of months ago, February, March, when the yen did weaken quite a bit following an easing measure. That's probably emboldened their policymakers a little bit to keep pushing on that easing lever. I think in a big picture sense, though, it equates to pushing on a string, and I don't think there's going to be a market impact on the yen. I think we've seen the highs in the yen, incidentally, for this year already, but I don't think that we're going to see a market weakening of the yen from current levels.
And Adrian, talking very quickly about easing policy, does today's preliminary number from HSBC and market about manufacturing in China contracting, does that confirm we'll see further easing measures in coming months?
I think we will see further easing from China, but I think looking from the outside, we're perhaps overstating the extent of the slowdown there. And I tend to think that Chinese authorities are actually happy with a little bit of the steam that's come out of that economy. I think we're down at growth rates around about the 8% now, 8% year on year. provided the global backdrop doesn't deteriorate further, I think we're going to hold that sort of growth rates through this year. I think we will see a decrease in the reserve ratio requirements, and we will see a cut to the interest rate, I think, in China. But on the interest rate front, I think only one cut. And I think at the end of the year, we'll see that China's simmering along at 8%, if you like. Not particularly impressive, but downside fears not being realised.
Adrian, thanks for joining us today. Rabobank International's Asia Head of Financial Markets Research, Adrian Foster. Thanks for joining us today.